So our first panel today is Innovating Smarter, Technology's Impact on Policyholders, which is moderated by Dean Cameron, NAIC most recent past president, and the director of the Idaho Department of Insurance. And Director Cameron will be joined by Lauren Cavanaugh, Director, Risk and Regulatory Consulting, Josh Hershman, Executive Vice President of Insurance, FairPlay AI, Dennis Noordhoek, Director, Public Policy and Regulation, Geneva Association, and Jane Ream, Chief Data and Analytics Officer, Zurich, North America. So please join me in welcoming our moderator panelists.
Thank you, Gary. It's a pleasure to be with you. And pleased to have these fantastic panelists, or three fantastic panelists and Josh.
Ouch.
Josh, as you know, originally comes from the Connecticut Department of Insurance, and so we expect plenty of Slido questions about Andy Mays that Josh can answer, maybe even some he can't. We are obviously in this day 2 of our international forum and our dynamic discussion about the utilization of innovation in the work through and the utilization of innovation through working through barriers that exist in the insurance field. Innovative technologies have certainly been dynamic and revolutionary as they've changed. I know in my time through the industry, I've watched dramatic changes in how we use technology, both in the marketing and in the way we process and in the way we underwrite and all of those adaptations. And it's fair to say that change is here to stay. I think we'll continue to see innovation in technologies move forward. But with every new innovation seems to come a new set of concerns or standards. Obviously we've had lots of discussion about algorithmic bias and that lack of confidence in maybe what the innovation is providing that we need to discuss. So hopefully in today's panel we'll dig down a little deeper and provide some of the nuances to technology and help us work through and have an open discussion that way. So my first question is for all of the panelists that are here today, and how do you see innovation as an opportunity for the insurance community, and how are your roles transformed with that innovation compared to the past? And we'll start with Jane.
Okay. Well, thank you for having me here. I believe it's actually an opportunity to really rethink the role of insurance and adopt more of a modern approach. So for centuries, the focus of insurance, as perceived by society at large, was to enable getting back on one's feet after a calamity has struck, thereby providing some peace of mind. Innovation these days allows us to transform and modernize risk management by focusing on preventative services through behavioral change and smart adaptations that will result in less need for mitigation and restoration. We know that preventative measures on average cost just a fraction of what restoration or remediation efforts will amount to after an event has taken place. Zurich aims to transform itself towards a risk prevention service provider, with traditional risk and insurance transfer becoming the complementary residual activity within an overall risk management approach.
So I'm already messed up my instructions. I should have started with Lauren. So we'll go to you, Lauren, and then Josh. And then Jane, if you want to add anything, and then we'll conclude with Dennis on that question. So, sorry.
No problem. Thank you, Director. And thank you for inviting me to speak on this panel. Yesterday, the panelists and the discussion was really, really interesting. And one thing that just kept coming up in all these different topics was innovation. So let's talk about this. And really, innovation has always been a part of the insurance industry. And a couple things come to mind from my perspective. In auto insurance, we have now usage-based insurance as a new innovative product that was in place prior to COVID, but now in this post-COVID environment that we are, people are driving differently, so having that product in place is really opening up the ability for consumers to get the insurance they need with the pricing that's flexible for the driving that they're doing. Another thing is catastrophe modeling, which I think, Jane, you were referencing, and not only to understand the risk, which we've been doing for many years, but now also using those tools to then mitigate risk, especially in this environment of constant change in our climate. I am an actuary, so you asked about the role that we each play. So for me, how I've seen actuaries' roles change over time is because of the complex modeling that it's in place right now. A lot of the role now is explaining those models to others and also considering the ethics and how we can better measure whether or not insurance practices, and especially pricing and underwriting, are fair, ultimately. I also consult to regulators, so from that perspective, I could say that because models are so complex now, the focus has almost necessarily needed to be looking at inputs going into the model, as well as looking at what the outputs are, right? How these models are being used, rather than like an intense focus on what's really going on within the models, which I'm sure we'll talk about as we get into some of the other questions. But so overall, I think it's a very exciting time to be part of the industry, but as you mentioned, there's some caution that we need to have.
Absolutely. Thank you. Josh?
Great. Well, I think it is an exciting time to be involved in the insurance industry, and I think of innovation and risk mitigation as hand in hand. I think if you think about the direction that the insurance industry is going, think about what Tesla is trying to do, think about pricing the risk that's in front of the consumer at that very moment. So if you get in your car and you're speeding, your auto insurance should go up. But your life insurance should also go up because you're doing something that's a little bit more risky. And maybe your home insurance should go down because ultimately you're not home and that's a large peril for you to be in your house. So it should all be talking to one another, all the different insurance products, and the consumer should have a seamless experience, and there shouldn't be risk waste that's taking place in the industry any longer. And I think that the only way that we get there is by solving some of the questions Lauren just asked around the modeling, understanding how to address these complicated models from an anti-discrimination level or a fairness level or whatever each jurisdiction is going to be interested in, and also figuring out the flow of that data. How is data going to move? How are carriers going to be okay with this, complete mishmash of different policies going up and down based on the risk that's in front of the consumer? But I think that that's interesting. I think that that's the direction we're going to go, and it kind of makes sense. Why am I paying for risk that's not in front of me right now?
Okay, wonderful. Jane, I'll give you a second bite at the apple if there's something you want to add, and then we'll conclude with Dennis.
No, I actually agree very much so. I think that climate change, ESG, sustainability, these are kind of new and unique risk factors that we really need to account for. And one thing I'll speak to is, in part of some of the other questions is, I think you touched upon it as well, is what I call removing friction from the process. There's a lot of handoffs and waste in the transition between customer, broker, carrier. And I think there's a unique opportunity as an industry for us to tackle some of those more mechanical and operational items, and that's actually a significant area of focus for us. So thank you.
You bet. Thank you. Dennis.
Well, first of all, thank you to the NAIC for inviting me to speak here. I work for the Geneva Association, which is a global insurance think tank, and as a think tank, AI is naturally a topic that we are thinking about and concerned about. I think it is really important to take a step back and think about why we're innovating. As a Geneva Association, we're always very much concerned about protection gaps and how to close protection gaps. We've written numerous papers on that topic, and I think technology or innovation is an important tool to help to sort of narrow those protection gaps. As a matter of fact, I've seen a statistic recently which shows that the adoption of AI within insurance is actually lagging behind other industries. Now, it's always a question to what extent those statistics are really accurate and representative, but I think it's kind of a sign, there's probably a road ahead of us. I mean, during COVID, we have seen that the industry took really big steps forward in sort of innovating and digitalizing. But then the other question is, why do we innovate, right? It's not for the sake of innovation. I think the landscape around us is changing as well, which, as a matter of fact, we've seen that life and P&C premium growth is lagging behind GDP growth, which means that there are new protection gaps. We are seeing, and I think it was alluded to, autonomous vehicles, right? This the shift from personal to commercial lines. Well, how can we play a role as an industry by adapting to use those technologies and innovate? And the other points, and I think it's just a bit of a repetition of what has been said earlier and yesterday. I think it's kind of being ChatGPT summarizing all the AI-related comments being made, but it's really around how we revolutionize our risk assessments. The idea that we can, enhance our value proposition to society. So it's not just about more granular risk assessments, but it's also about helping society become more resilient and mitigate risks. And I think technology is really important, or innovation is really important in that respect. So I think to summarize my points, innovation is really important to sort of contribute to the AAA, as we call it, to enhance affordability, accessibility, but also availability of insurance. And that comes back to my earlier point on protection gaps.
Interesting. So I want to ask you a set of questions that focus on the role of the regulator. And we'll start with you this time for sure, Jane. Can you tell us how Zurich has increasingly ramped up their use of data and technology to spur innovative ways of doing business, and what has been your experience in interacting with regulators in that area?
Sure. So, data analytics is definitely a hot topic these days. I'm actually surprised that I was let out of my cave. I don't usually do these types of things, but maybe I'll tackle the first part of that question. Like I alluded to earlier, the newest area of focus for us is really trying to leverage AI and technology to remove friction from our process. Insurance as an industry is an incredibly paper-based industry, and it creates a significant amount of operational inefficiency, and we're just chronically understaffed on the carrier side. And so we have been leveraging AI, especially most recently, to just try to help operationalize it and embed it deeply within our business processes so that we can help our customers get servicing faster. We can help the underwriter get information faster, or the claims processor get information faster. And so that's really been a significant area of focus for us to leverage AI very specifically in our domain. When it comes to the second part of the question, which is around experience with regulators, it's been a very good experience. High-level regulators such as commissioners and deputies are often very supportive of innovation, and we definitely feel that. I think we certainly appreciate the opportunity to kind of collaborate and speak with regulators, especially during the innovation process, as opposed to post-processing and asking for approval. And so that dialogue has actually been very helpful for us. We deliberately adopt a proactive stance with regulators as well. At Zurich, we take social responsibility very, very seriously. And we value the trust of our communities and customers, specifically entrusting us to use new and innovative technologies responsibly. We have imposed ourselves limits and clear guidelines as well, which we actively share with and explain to our regulators. So some visible examples are our Zurich data commitment, as well as our AI assurance framework.
Thank you. We'll go to you next, Lauren. In your work and with exchanges, and your exchanges with regulators, have you found concrete direction from regulators to insurers, and how do we as regulators make sure that direction doesn't become obsolete the minute we dispose of it?
Yeah, no, absolutely, great question. So I think that, from my perspective, the direction that regulators have been given, especially on the rate filing review perspective, is some really good guidance out there, questionnaires, so that companies really understand for each state what are some areas of concern. More could be done, I believe, in that space, but also that type of guidance could be expanded then to some of the other insurance practices to a greater extent. So, for example, if certain regulators are sensitive to understanding the use of telematics or catastrophe modeling results, or using credit in pricing and underwriting and things like that, understanding what are the concerns. So regarding the second part of your question on how do regulators make sure that their guidance and direction doesn't become obsolete, I think it really has to do with providing to the industry the principles behind what the concerns are and what they're looking at, rather than just specific specific issues and things. So that's what I would say.
Okay, thank you. Josh, from a company perspective, how can regulators, the sheet says helpful, but I'm not sure helpful is the right word, but how can regulators assist in companies that are growing quickly or scaling faster than legacy companies?
Yeah, thank you. That's a good question, and I'm probably going to aggravate Dennis because I know his question, and I think there might be some overlap. So I'm sorry, Dennis. But regulators have done a good job, I think, over the past 5+ years in meeting the innovation where the innovation is taking place. Just recently, there was the InsurTech Hartford had a symposium, and there were 3 chief regulators there on a panel explaining to innovators exactly how to communicate with them. And the answer is communication. It is regulators need to be open to communication with these fast-moving organizations, and these fast-moving organizations need to know that they can communicate with the regulator and ask them, reasonable questions. And that, I think, is really the root of how there can be success for the fast-moving organizations. And I know legacy companies don't like to necessarily be called legacy companies, but they're moving awfully fast too. They're moving, some organizations are moving much quicker than other organizations, but they're moving fast. Their advantage is they already have entire networks set up to communicate with the regulator. So it's harder for the smaller companies and fast, and the startup world to understand that the direction and access to the regulator. But the NAIC also has done a phenomenal job in categorizing and outlining who to contact in each jurisdiction for an innovation lead. So I think there's a lot of opportunity out there for those smaller, fast-moving companies or startup world companies. They just need to communicate, and the regulators need to communicate. And going to the source, going to those events, I think it's a big deal, and it means a lot to that part of the industry.
So in following up with that question, we are going to go to Dennis.
Yeah.
So how important is it for regulators and supervisors? It seems silly to ask, but how important is it for us to maintain ongoing dialogue with you all as stakeholders? And what do you see the most impactful methods? I think I want to hear more on the second half of that question. What are the most impactful methods for us as regulators to communicate with the industry?
That's a very good question. And I think in my answer, I would like to highlight 2 different stakeholders. So one is the industry, but if you look at things happening in Europe, I think the other wider policy-making community is super important as well. But let me start with the industry. I think a dialogue is really needed, and just building on your point, really for the supervisory and regulatory community to understand the technologies, how they're evolving, how they're used. to assess the risks and to understand what is going on. I think an ongoing exchange and dialogue, and we've seen it in jurisdictions like Singapore, where there is this ongoing dialogue with the between the supervisory community and the industry around principles and how those principles are being implemented. I think that is an extremely helpful way to avoid that you have to tightly regulate it, but you can really take a more principles-based approach. The other point is really around the communication with the wider policymaking community. And why am I saying that? So in the European Union, you're aware there's the AI Act being developed. And of course, the industry has different views about that. We know that part of the life and health industry, or AI applications in life and health, are deemed high risk. And if you talk to people in Europe, you get the impression that there is not always an understanding and appreciation on the side of the wider policymakers that are dealing with the EU AI Act as to how insurance is regulated already, how AI is being used. And I think it's really important for us as an industry, including the supervisory community, to convey those messages to other policymakers to really create this understanding as to how we as an industry are regulated. And I think to the second point of your question, I already mentioned Singapore. I think it's just important to engage in workshops and ongoing dialogue. It could be done through public consultations and questionnaires. I think there are many different forms in which this can be done effectively. Now, I can only speak for the Geneva Association. I mean, we are not an insurance company, so we are, in that sense, having a slightly different take on our interactions, but we do really appreciate our regular interactions with the NAIC, with the IIS, and other supervisors and regulators around topics that are keeping them awake at night, and how we can sort of implement it in our own working plan and address some of those questions that both the industry and regulators have. So I hope that answers the question.
Yeah, it does. I'm wondering if the relationship is established beforehand, if that's more beneficial than trying to establish the relationship as you're bringing forth a new product line or a new approach for the use of technology. I don't know if you have any thoughts on that.
That's a good question. I think having an established relationship, an ongoing relationship in that sense, is probably really, really helpful. That really allows to sort of tap in new developments and rather than sort of on the go. But I guess views are different there. They might be different.
So since this is the international forum, we're going to now twist this a little more to an international perspective. We're going to go back to Josh. In keeping with the international focus of this forum, how should the U.S. insurance community remain engaged globally to ensure state regulators and the industry are on the forefront of innovation and modernization conversation?
Yeah, and I'm going to recycle my answer a little bit. It's going to be communication. There's so much going on internationally right now in this space. China recently put out their proposal for how to deal with generative AI. The EU just recently put out guidance on the utilization of AI. The state of Connecticut just is passing a law around the utilization of AI. There is so many different little pieces related to this, and I think it's incumbent on each state regulator, the IAIS and the NAIC, to make sure that everyone is kept informed and holding events like this to have these conversations so that best practices can be cultivated and utilized across the borders. At the end of the day, this technology and innovation is not stagnant to one state, one jurisdiction, and I think that we're going to have a much more global approach to standards around the use of some of these tools, and there's only one way to facilitate that, and that's communication.
Yeah, great. And Jane, you mentioned, as we talked earlier, about Zurich's approach, and we're watching AI proposals and regulations being proposed across the world, different approaches, and a variety of different jurisdictions. How does Zurich maintain understanding of each of those proposals and engage in the conversation surrounding them?
Sure. But I have to ask Josh, is Zurich considered a legacy company? I'm curious.
I'll defer to the group.
So maybe just to echo what Josh said, it really is about communication and collaboration. So even within Zurich, we're obviously a very large and complex organization, and we have a really great network of folks in collaboration. We have, a government and regulatory relations team. They work very closely with my data governance team, just so we're abreast of all the changing regulation that kind of comes up. But again, we really want to also maintain a proactive approach. And we're really supportive of the proposals, especially with the attempts around standard definitions, explainability, and transparency around the innovation, especially around AI and the models that we do build. And so again, just trying to be proactive as much as possible. And we do actually aspire to also lead the industry in the space of responsible AI as well. So with the recent explosion of AI, it's all kind of within our collective consciousness. We see the questions coming up. We understand that there are concerns in this space, and I really feel as though it's just important for us to keep those channels of communication open so that we are really optimizing to kind of everybody's interests at the same time.
Okay, thank you. Lauren, predictive analytics have been a topic of many discussions in international organizations such as the International Actuarial Association and, of course, the International Association of Insurance Supervisors. In your role at risk and regulatory consulting, how do you participate in those discussions? And can you touch on some of the key themes from an actuarial perspective?
Yeah, no, absolutely. So, yeah, I think that there, has been, for sure, increased scrutiny on predictive models, and more broadly to, the more sophisticated and complex these models get with AI, the more scrutiny there is, I think, because, it's that perceived, at least, black box nature of these models. So, really, questions on, how can the regulator really understand what these models are doing enough to be able to fulfill their role to protect policyholders, but also do insurers even understand it to the extent that they can explain it right to regulators in a way that makes sense. As actuaries, the questions of model bias and bias generally has been very prevalent, hot topic today, as even our actuarial standards are being looked at, and continuing ed in these areas in a way that hasn't been in the past. So I think that's all good, but I would say probably because of this, there's been sort of three main areas that I would highlight. One is just sort of the regulation and the definition, really, of unfair discrimination has been coming up, and even redefining unfair discrimination and what that means here and abroad. As I mentioned before, really a focus on inputs and outputs of these models. So, how do regulators, decide what variables should be included, and how do companies justify those? The NAIC has, put out maybe one example of using rational explanation as a test, right? So if an input doesn't seem to have any relationship to risk, maybe additional scrutiny is needed. And of course, another big area right now is on the questionable outcomes, right? If there's, outcomes that produce, possible, at least perceived disparate impact, what do we do then?
Right. Thank you for that answer. Dennis, how should supervisors around the globe approach data collection through innovative methods? And do you see initiatives like the EU's AI Act or the GDP framework, do you see them translating into other areas?
Well, with GDPR, we've already seen that it is being used in other jurisdictions. I mean, California has created their own version of GDPR, so I think it is widely used. And I think GDPR has elements to it that are actually applicable to how we use AI. I mean, automated decision making and the right of a data subject to be excluded from that, or to sort of object to that. But let me zoom in on the EU AI Act for a second as well, because I think that's really a crucial discussion going on in Europe, and we are seeing that other jurisdictions are actually looking at Europe, what is happening there, before they sort of contemplate their own approach to whether or not a cross-sectoral framework is needed. And I think there are a couple of problems with the EU AI Act, in the sense that it doesn't really, fully appreciate the way insurance is regulated. We've seen an initial definition that was extremely wide, a definition of AI. Now, there are discussions on whether you need a definition or not, but I think when you're regulating, it is good to understand what it is you're regulating. And I think the original definition was really so wide that people said, well, you could actually consider advanced statistics or analytics that is being used already by the industry or software in general to be AI. Now, luckily, the discussion has gone into in the right direction, where the definition is currently narrowed down to, I think, following the OECD definition, which has really a focus on machine learning. And I think that really goes to the heart of AI, the idea that there's this feedback loop and that the algorithms, or at least the parameters, are changing. So I think that is really an important element. And I think that again links back to sort of the idea that insurance, or at least AI applications within insurance, at least within life and health, as discussion is going on today, are considered high risk. Now, I'm not saying that I just want to sort of put out a disclaimer here, I'm not against regulating AI, and I mean, if you look at AI, there is AI and there is AI. And we are currently working on a paper within the Geneva Association that tries to sort of take the hype out of AI, really looking at how AI is being used in the insurance industry across the value chain, what the risks are, but also looking at, okay, if you take 2 or 3 important jurisdictions, how are those risks being regulated by existing frameworks? So that is really an important point. And if you look at decisions being made within insurance versus other high-risk applications according to the EU AI Act, you have things that endanger people's lives and health. The thing that comes to mind is the autonomous vehicle that needs to take a decision, and I would say that if it ends up in an accident, that's irreversible. On the other hand, decisions within insurance are mainly administrative decisions to underwrite, to whether or not to pay out a claim, or to assess the amount that needs to be paid out. Of course, I'm oversimplifying here for the sake of the argument, but to what extent is it on the same footing as something that endangers people's lives? So I think the nuances are missing in that framework to that extent, and I think that's why I think it is kind of not ideal to sort of translate it to other frameworks and to industries like insurance that are already heavily regulated. And I'm not saying that there are no other industries that are regulated, but we've just seen a statement from Sam Altman and from the CEO of IBM, we need regulation around AI. Maybe I'm offending people. Maybe it's fair to say that the tech sector has originally been less regulated, and they are seeking guidelines around, sort of to create the regulatory certainty around what they can do. So how does that translate to insurance, for your question? I'm not sure whether this is the right approach to deal with the risks that we're having within insurance.
Yeah, it's an interesting conundrum in a way. I think every regulator in the room, although certainly AI wouldn't be considered to be life-threatening, AI could be life-changing. Mm-hmm. And our role in the next segment that we want to ask questions about is to protect the consumer. And with every new technology or new innovation, for regulators, we're looking for confidence, and our consumers are looking for confidence that the information that they share isn't going to be used inappropriately, that there isn't some bias that's going to be either installed and utilized in the purchase of insurance, or even worse, being used, perpetuated into the future because of some perceived bias. So I'm going to go with that in mind. I'm going to go back to you.
Can I ask
You bet.
Interject a piece here? I think everything that you said, I relatively agree with, and it's a very complicated question. But there is a component of insurance which is life-threatening, and we're starting to see models that are being used to answer some of those questions, and that's on the health side. And so understanding when or what procedure to have based on a big data set, and that person not having a procedure or having a procedure, that's life-threatening. So I think it's more complicated than what you described, and it's going to be a very long slog to get to where we're trying to go here. So I just wanted to.
No, that's an excellent point. Very good. You've now contributed to being on the panel, so
Great. So I can go.
So we're grateful to have you here. So Jane, the market has shown that the use of innovation can and may highlight some more personal approach to consumer needs. As I read that question, I thought to myself, okay, I can see how it does in some ways. I can also see how it might distance a personal approach if with the use of technology. Can you explain from your perspective the demand for personal solutions versus offering traditional products based on demographic segments and how that helps elevate consumer satisfaction?
Sure. I think for us at Zurich, it's a little bit different because we work on the commercial P&C space. And so we don't directly have customers that are individuals per se. And so I would say when we think about personalization very specifically, we think about not so much the products, insurance products we offer, but the services that we offer, especially through our risk engineering services. So how do we help our risk managers at large corporations mitigate their risk or transfer their risk? How do we prevent claims from actually happening? How do we take risk engineering and really help them understand behaviorally or structurally how to mitigate the frequency of claims from actually happening? So that's how we choose to think about personalization, is to provide those risk engineering services directly to our customers.
So let me unpack that just a hair further. Innovation potentially has the ability of helping you as a company determine the appropriate risk and the appropriate charge. But in so doing, it also can eliminate the spreading of risks. And so I'm trying to sort of balance both of those concepts. The traditional approach would be we buy insurance to spread the risk, so we're to share the risk. Innovation allows us to target more specifically down on the risk. So how do you balance that out? How does Zurich balance that out?
It's a good question, and I probably would need to defer a little bit to our stronger business folks within Zurich. But from my perspective is, we leverage AI to potentially assist in the risk selection process. But it is really a framework, and I don't foresee a model per se saying this is the precise product for you. I can see it kind of helping to come up with recommendations to say, what does your risk profile look like? How do you diversify that risk? Not just within Zurich, but across the actual risk mitigation process. So that's kind of how I see it specifically.
Okay, thank you. Dennis, what would you say are the key elements to balancing consumer protection with the need to foster an insurance field that's looking forward and is competitive?
Well, let me just build up on the previous discussion where I might have given the impression that consumer protection is unimportant. I think it is key. It is super important. And I think we as an industry have a role to play there as well when it comes to sort of fostering this trust for us to be able to use new technologies and AI. So I think that is important. But I think the other point I wanted to sort of build on is looking at, again, the regulatory frameworks around there. And I think you mentioned bias, you mentioned a number of risks, right, that we need to be concerned about when we're using AI. And I think it is key as an industry to keep those risks in mind. But at the same time, if you look at how those risks are currently being regulated, you could probably argue there are, if you look at the regulatory frameworks, in many jurisdictions have been developed in a tech-neutral way. So they are capturing some of those risks to a certain extent. So what you see in, for example, the UK and Singapore, and I think the NAIC is contemplating something similar around this, is that you take your existing regulatory framework and you look where you can issue guidance to sort of apply that to specific aspects of AI. So I think that is really, I might sound like a lobbyist here, but I think from sort of our point of view, important to consider. So that's really, I think what I can add to that point.
Yeah. Thank you. So Josh, you come from a unique perspective. You're now on the industry side. You've been in the regulatory arena, and you know Connecticut's been a leader. You know that innovation can be vulnerable to bias and discrimination, whether intentional or not. What should, from your new hat, what should regulators do to maintain that the consumer can be assured that bias hasn't occurred, or that the data or the algorithms that are being used to make critical decisions are not biased or otherwise untrustworthy?
Yeah, well, I'm happy I'm not a regulator answering this question because it's a tough one, and it's really tough because what is bias in insurance regulation, and you know, what part of that value chain are you thinking about? My opinion is it should be the entire value chain. It should be from marketing all the way to fraud protection. But there is when you look at all the different jurisdictions, and most of the anti-discrimination laws sit in the underwriting and pricing piece of it. They don't really touch on the outsides of it. So you have to really have a conversation with insurance departments in jurisdictions to say, what is it that you're worried about on the bias side, and do you currently have a law that would allow you to regulate this? Because the first thing industry is going to say is, I'm sorry, where are you getting? Is this a desktop rule? Which I know insurance departments are constantly trying to move away from to make a more practical, regulatory regime in the United States. So it's tough, but I think that California went out with a bulletin, and that bulletin outlined, I think, very succinctly that bias can happen along every component of the insurance value chain. And they tied it to different components of their law. And I think that it's going to be interesting to see how they build out that framework around it. Colorado has spent an awful lot of time, and I think that they've been moving in a very, now they're moving at a relatively quick pace, and I think that you have to have some form of model risk governance. That has to exist. What's inside that? Inputs, output testing. What does an output test look like? It depends on which part of the value chain you're at. And then you might want to have, is it going to be an adverse ratio output test? Is that disparity that's going to exist? Is that going to be the same level that you have on the the banking side that the CFPB put out for different components? Is it going to be a different type of output test to determine whether it's a bias? So it's a very complicated question, and I really think deeply on the matter on a regular basis, and I don't know what the answer is going to be. I'm very much looking forward to seeing what the NAIC says in this. I love I think what the EU has done is super interesting, but to make the consumer feel like they're not being taken advantage of, or there isn't some form of bias, there are a lot of unanswered questions, and hopefully we can answer those questions quickly because technology is moving very quickly.
Yeah, and it's a challenge too. And you mentioned California and Colorado, and if I'm hearing correctly from industry, those are two states where it's been extremely difficult to market in. And so then you start having potential access issues if consumers can't obtain the coverage they need. In some ways, that may be unintentionally creating an additional bias there.
Yeah. It just gets more and more. And Lauren, you said something earlier that I wanted to interject, but I didn't. And I just wanted to know, maybe you don't need to answer the question, but we talk a lot about output testing and input testing. I'm just wondering, from your perspective, does it matter if there's no input issue? If the regulator doesn't care about the input, all they care about is an output. Is this violating a law? What's the impact of something like that? Or do you have, is that a silly question?
Well, so your question is basically, why look at inputs?
Yeah,
only look at outputs.
Only look at outputs, yeah. That's my question.
Yeah, I think part of the answer to that is that, when then, if you were to see, maybe that's the first step, right?
Yeah.
Maybe the first step is looking at outputs, and I think that's what DC, to call out some of the jurisdictions, DC is looking at, right, doing a data call to kind of do some of that testing and see what is there. But then what's the next step? So if there is some, differentiation in premiums or loss ratios or whatever it would be, based on, they're focused on race, then what would be the next step? A lot of times, right or wrong, right? A lot of times people will go to then the inputs, right?
That makes sense, yeah.
Restricting the inputs, because restricting the outputs is,
It's tough.
unclear, yeah.
And maybe I can take a shot at that question too. What you want to be mindful of is not exacerbating the bias. So if you don't look at the inputs first, you'll potentially compound the impacts of bias in the outputs. And so we have multiple control points. We do look at inputs, we look at outputs, but we also look at model monitoring to just make sure, and I think somebody made the point earlier, we now have models to test our models that test our models. And so that's just kind of the ecosystem that you start to create. But I do believe it is important to focus on inputs and outputs together.
That's a good question. So I want to come back to it a little bit with you, Lauren. As an actuary, we have, as a regulator, we have great confidence in our actuaries. For whatever reason, we believe, I believe when my actuary says, yeah, this is, everything's appropriate. And so that confidence is helpful to us. What are the tools that actuaries have or data scientists have to be able to determine or measure if there's bias inherent in a product?
Yeah, no, and I think what Josh was saying before about what bias, what is bias, right? How it's defined is going to change, what tools you're going to use to measure it. I totally agree, Josh, with what you were saying about it should be across the value chain, because if the focus is only on pricing and underwriting, you squeeze that part of the balloon, right, and something happens over in marketing or just in the availability of insurance, and we see that. So, but maybe focusing a little bit on pricing and underwriting as examples. Even within there, the questions can look different, right? So questions on, are there higher premiums for certain groups, or relatedly, is there affordability issues for certain groups of consumers are a few questions to ask. But then also, you can also ask about, are certain consumers just denied coverage, denied applications, or just there's just unavailable insurance in their area for one reason or another. Actuaries, and regulators traditionally have thought in pricing about matching premium to expected costs. So another question could be, are certain groups, paying more compared to their expected costs? And each of these questions, could yield different answers, and we'll have different metrics and tools to be able to test for them. But I think this is where, and we've touched on this a bit already, where, technology can be part of the solution, right? Models to test models and things like that. There are statistical fairness tests that, just to kind of explain that concept in a little bit of detail, just kind of looking at, each model, a predictive model at least, is predicting a certain outcome. You can compare that to actual outcomes, and that's that difference we call the error. And so if there are different error rates that look different for certain groups versus others, that can then indicate that there could be, a bias issue there. And then, we talked about outputs before. There's tests that you can look at, just, the pure output, which we've touched on before. So I think that there's, a number of different ways to test it, and I'm just scratching the surface. There's a lot of different things to do here, and that can be, absolutely should be part of the solution here.
So I'm going to stay with you, and we're going to shift gears just a little bit and talk about purposeful change. Risk literacy is a concept being explored more fully as we continue to have conversations about innovation, and the consumer. How do you see technology and innovation outreach techniques benefiting the consumer?
Yeah, I love this question, and we've I think hit on a little bit on the commercial space how that can benefit the consumer, but on the personal lines, I think we're seeing already, for many years, the use of telematics being able to really enhance how consumers understand their risk. They can get a real-time, little ding when they're, have a hard break or whatever it might be. They can look at the month and look at their app and see, gee, my teenage son is doing certain things from the, driving habits and things like that, and have much better understanding and handle on the risky behaviors. I think it could be, there's so much more potential there, right? Like insurance companies are just experts at understanding risk, and so greater amount of interaction and communication with consumers could only serve to help. And we see it in some areas, I could see, and maybe some insurers are doing this, but messaging out if for a homeowner, if an application is denied because of, risky tree cover over the roof, right? Messaging that so that the consumer can, fix that. And, apps or different things on the commercial lines too, which I'm sure, Jane, you could discuss. And I would also, though, say that that there is a risk, right, that technology is used, and maybe it's the way that it's applied, right? Right now in our society, wanting very, very quick decisions, apps that kind of get you to binding a policy within seconds is what consumers want. But does that actually inhibit the risk literacy? I think it can. I've seen, examples where, you have, just a couple different questions you answer, and here's your policy, but, not as much options and explanation in the coverage that it's providing. And so that's a risk that we see with some of this technology. So as far as the role of the regulator too, I think is, kind of what, with the information that insurers have, what should be then communicated out to the consumers, because I think that could be something that the regulator could put some additional input into.
Interesting. So Jane, let's go to you. What sort of purposeful change does Zurich see as critical in creating new products and services?
Yeah, I think it's just to kind of piggyback off of Lauren's sentiments. The whole notion of risk prevention is really the direction that we're trying to take. And we look to technology. IoT is another example you see in telematics. In the commercial line space, you see it in workers' compensation with the wearables, repetitive movements, trying to really understand and prevent injury. Property similar to telematics. On the property side, you have a lot of property management, early warning systems. And so it's really trying to tap into the IoT world and the IoT network to try to prevent the loss from happening. So yeah, again, just piggybacking on the notion that we're really trying to move away from the frequency itself from happening. That's really the direction that we want to go. Lots of ESG considerations, sustainability, climate change. There's just so much out there that we're really trying to get ahead of to really kind of be on the lookout for our customer base.
So Dennis, last year, the Geneva Association released a report, and it's been mentioned a couple times here yesterday in panels. The responsible use of data in a digital age is the report.
One moment.
Was that artificial intelligence?
It must be Siri. I don't have ChatGPT on my iPad.
We've given you your moment, so Dennis, can you talk a little bit about the report and your perspective of using artificial intelligence and in relation to the rise of personalization of insurance?
Yeah, very good and very important question. So the report that you highlighted actually discusses the opportunities and challenges with the use of AI in insurance. Now the benefits, and I think we've already talked about it for about a day and a half now, are improved risks assessment, expanded insurability of risks where we didn't have the data and information in the past, better affordability and tailored coverage. But there are also customers potentially being disadvantaged because of this hyper segmentation that is very often used, where you have a more granular view on the risk, and certain customers might unfortunately be a higher risk and therefore be subject to a higher premium. And I think, as an insurance industry, we have a role to play there. So sort of this undermines sort of the pooling of risks, and sort of the idea that you have this pool which is sort of supporting each other. And I think what the paper does, it comes with a number of recommendations to really look at this issue. So one is really differentiating between data collection, use, and I think that comes to other points around bias and discrimination, that you need data to be able to test, what the outcomes are. But it's also about defining responsible data use, and I think there are probably also cultural elements that, and I will point that out in a minute. Then there's the idea of applying principles-based governance and establishing a trust framework, which requires constant engagement and dialogue with consumers, with consumer representatives, and with regulators and other stakeholders in the industry. And I think one of the questions here really is, to what extent is it a bad thing that more granular risk assessments lead to higher prices for some customers? I think you alluded to that earlier. This is a signal. This is the communication function of those risk assessments. The question there is, well, if the consumer is in a position to actually change behavior, like, this is a signal I get. I can adjust my behavior. I can reduce my risk. And now I get the fare or the premium that I can afford. There are probably also situations where a consumer is not able to adjust behavior or adjust anything in things he or she does. And therefore, you could consider it to be unfair that there's not this pooling of risk or this cross-subsidization, so to speak. And I think there are different views. On the one hand, you could say, well, there's private insurance, it's not social insurance, and if this is one of the risk communication functions of insurance. And the other aspect is really, around can a consumer influence their risk or not? And I just recently read a report from the Dutch Financial Market Authority, which is quite interesting in that respect, and I think that is where a cultural dimension comes in. They said individual pricing is not a bad thing at all, as it allows for risk reduction. And they pointed to the role of governments in supporting customers negatively affected by individualized pricing, and I sort of interpret that as to those kinds of risks that the customer can't really influence based on that information. Now, I think that this is really, again, very much based on the cultural context. Might not be really something that you can discuss in the United States or in other contexts. But I think this is really something we, as an industry, need to be aware of. We need to have those discussions with regulators, with consumers, and with consumer organizations, like how far can you go and where do you draw the line, while still benefiting from the information that those tools generate to actually mitigate our risks or reduce our risks.
Yeah. So it's a challenge, because I think we've been all advocating for that transparency so that the consumer knows and can make that change if they know. But oftentimes, as a regulator, we're not seeing that transparency as being forthcoming, or the accuracy of what's being shared as being forthcoming. So therein lies a little bit of the rub. Ideally, consumers would be able to benefit by that information and would be able to modify their risk if they knew. Mm-hmm. But oftentimes, candidly, they don't have a clue. I'm going off script here, but I just recently had a situation where a pretty prominent company made a pretty prominent rate increase on these individuals' property casualty coverage, and they were well connected, so they knew the right people to call, and they started with calling the company to find out why, which ironically pointed to my department's change in credit scoring and rules. and yet that wasn't the reason for the rate increase, but that's where they pointed them. And so then when we visited with the consumer's credit hadn't changed. In fact, if anything, had improved, yet they were getting a significant rate increase. So I love the idea of being able to provide more information to the consumer, but as we would say in farm country, the water's not getting to the end of the row. So we'll look forward to that day. Josh, what with the recent release of chatbots and other similar technology, conversations on AI have moved into our daily lives at lightning speed. I mean, we even see our moderator getting jokes from ChatGPT and others. So what drawbacks do regulators and insurers and stakeholders and consumers need to avoid in order to benefit, have the benefits outweigh the risks for using this technology?
Yeah. So I think there are three important stakeholders, right? We want to start with the regulators. The regulators are going to want to make sure that that there aren't any violations of their current laws, whether it's in Europe, and Europe is doing, I think, a good job of trying to suss that out, or each individual jurisdiction in the United States. And that's, it's a complicated question for them. And one of the previous questions that you asked was around the regulation of that. So that's one piece of it. The other piece of it is the solvency piece that regulators have to be concerned with. Because when you think about it, the most important job of the insurance regulator is to make sure the companies are solvent. And when you think through some of the innovation that's taken place in the past 3 or 4 years, there have been some questions around solvency related to some of that innovation. So I think those are the two major issues for regulators. I think for industry is going to take this one step at a time. You see some major players just getting into the telematic space. You see some players that have been in the telematic space since 2017. And I think that it's a risk appetite. Each carrier has their own sort of risk appetite for these things, but I do think fundamentally they're going to be moving a lot quicker in this space internally than externally. And I think that most of the major carriers are starting to deploy some of these tools across their internal value chain, not necessarily consumer facing. The other thing is there a product that they're interested in putting out to the market that ties into some of these things? There might not be. So it might move slower on the product side, but it also could move quickly. And then on the consumer side, knowing that there's some form of AI that's a part of your insurance experience, it's important. You might want to know that if you're a part of a protected class and you're going to a hospital and talking to your carrier before you go in about a procedure, making sure that, there might not be enough data that you're pulling from to determine whether or not that this is right. So the consumer has to know that. And just innovation generally. I would never elect to use telematic in my car because I'm in a group of people where I have a great insurance rate. So a consumer, I think, has to be cognizant of the risks when they're using insurance products that have some form of AI or some form of innovation. So there are risks. They just need to be mitigated, and I think we can move quickly once those risks are mitigated.
I like that. You've got to be thoughtful in your approach.
Yep.
It may not be a benefit. Not every nuance may not be a benefit to you. So let me come back to you, Josh. FairPlay sees itself as the first fairness as a service solution for financial institutions. Can you unpack that a little bit and explain what exactly it means in the terms and the artificial intelligence tools that insurers can use to invest in future work?
Yeah, FairPlay has spent a lot of its time on the banking side, and I've been working with them to move it over a little bit to the insurance side. And really what they ask of the models is this model fair? If it's not fair, why? is there a less discriminatory alternative? What's the cost of that less discriminatory alternative? And then did you miss any people? And I think that at the end of the day, these questions need to be asked of pretty much all models that are being deployed. And the issue that obviously is different on the insurance side than on the banking side is that class of people is not really defined, right? Banking is comfortable using the BISG model to impute demographic data. The insurance industry has yet to really accept that and drive that home. So it's a very, it's a very difficult proposition, I think, for carriers to wrap their heads around. But at the end of the day, if I were a carrier, I would want to know the answers to some of these questions because regulators are going to start asking. So that's sort of the direction that FairPlay goes. And I think that, if you go to the first question, what are the things that are interesting in innovation that you're working towards? I think infrastructure pieces of the innovation process is super interesting and it needs to be addressed. And that's why I'm interested in the fairness question. I'm interested in the questions around delivery of data. And I think that the insurance industry has a long way to go in those spots. So I'm excited to be participating in that field.
Okay. Lauren, what sort of risk management frameworks do you advise companies have in place to counteract any issues that may arise out of too quick of growth?
Yeah. So when we think about the issues, right, related to growth, we think of, does the company really understand the new area? If it's like a new geography or line of business, do they really understand this business the way they do the existing business? And also just are they going to be able to keep up with the staffing needs as well? Because oftentimes, right, if there's, especially in the claims department, if there's issues with the, being able to keep up with the claims, then claim delays usually lead to, additional, higher payments and all of that. So I think, with that in mind, knowing the risk, hiring the right people, getting the right people in the room, and making sure that companies are staying on top of their staffing needs or using innovative ways to reduce the need for as many staff per policy. So I know we're running out of time, so I just wanted to just mention real quick that, again, technology can be part of the solution. The controls in place could include monitoring and enhanced dashboards that can really pinpoint some of the issues so that companies can course correct if they need to.
So because we're running out of time, I do want to catch a couple questions and instead of hitting the last two that were scripted for you. And anybody can answer these. I don't know that all of you have to, so just feel free to chime in. So as underwriting becomes so granular, is there a danger that some risks may become uninsurable, undermining the pool nature of insurance? Anybody want to take a stab at that?
I think I'll go first, I guess. I think that, what Dennis, you were saying about, giving policyholders the tools, right, to be able to reduce their risk, right, can really address some of these issues. So if their premiums or if they're denied coverage, if they're given that, information to be able to reduce the risk, that can be one thing. I would also just say that, increased granularity doesn't necessarily mean that there's not, risk pooling, because still there's that variable element of any type of risk. And so, really, if anything, the greater risk classification should allow for more risks to be insurable rather than less.
So maybe let me ask this question, and Jane, you may want to answer it. Are insurers prepared for the liability implications of this new technology?
That's a good question. Wow.
Well, a man, a plan, a canal.
Wow. Apparently, I don't know what's going on. I'm just going to shut this off. How about that? You know, obviously, we just have to be mindful of the emerging risks. Just like we cater to our customers, we just need to be mindful of our own emerging risks. And so, you know, I don't know that there's really a canned response to that, but it's just really trying to stay on top of it and just continually understanding and assessing the changing nature of that risk.
Yeah. Thank you. And my apologies to the others that submitted the Slido questions. I'm still looking for one on Andy Mays, but I don't see one there. So we'll catch those later. My appreciation to the panel, Jane, Dennis, Josh, and Lauren. Thank you for your contributions and thank you for sharing of your time.